Welcome back. So the market's still dealing with an ample amount of pressure, 370, 375 points down on the Nifty. There's been no real meaningful recovery. Very small bounces, but then they've been sold into, at least as of now. Let's see. We've still got about half an hour to go to figure out how this day closes. We have our next guest joining in now. Ajay Argal of Franklin Templeton is our alpha manager of the day. Ajay, thank you very much for joining in. First of all, season's greetings to you. Wish you a very, very happy new year. Well, for Indian investors, it's been a bit of a wobbly start to the year. Time correction in some cases, price correction, and relentless FPI selling. So far, Indian mutual fund investors have kept the faith. Do you think they'll continue doing that?
Yeah, so thing is, the Indian domestic mutual fund investors, they've seen very good returns over a long period of time. So they have also kind of matured. They kind of are looking to buy or increase their allocations on every dip. And of course, that confidence has come because the returns have been good. So as long as the returns are there, the flows are likely to continue. Of course, as we have seen in the last few months, the returns have been tepid. So if this returns being tepid continues for a longer period of time, say 1 to 2 years, then it would be interesting to watch what the reactions of the domestic investors would be.
Yeah, but I guess that's the critical question, right? Whether
Yes.
they can continue to stay invested even if there is a period of low returns or maybe no returns. But Ajay, let's get to the house view. I mean, on equities here, Indian equities, what's the call? A lot of people are calling for maybe just single-digit returns this year. What's the general stance? I mean, what's the house call, and what is the sort of construct with which you're going right now? More defensive, or you're looking for bargains in sectors which traditionally did well in early 24, like CapEx, like EMS, etc.?
Right. So the construct is that we are in challenging times. So as we have been witnessing, there is a bit of a slowdown, and it is across sectors. And initially, it started off with few sectors, and now it's kind of spread to many sectors. And then we have seen the GDP growth itself hit the 5% handle. And it is kind of reflected in the earnings as well. If you look at the first half of this year, the earnings growth for the top 500 companies has been almost zero. And therefore, the earnings downgrades have happened. And now we are expecting like kind of single-digit earnings growth for FY25. And that itself might be a bit of a challenge, as you were highlighting whatever the initial outlook from a few companies in consumers have come and a few banks have come. It doesn't look like there is a major pickup. So there is this kind of reality check which is happening with the kind of growth which we are having and the valuations which we are trading at. So the valuations are definitely not kind of anticipating the kind of growth which is being currently witnessed. Basically, they are on the higher side. And of course, the valuations for some of the pockets in the mid caps are extremely high. So as far as the constructs of the portfolios are concerned, we are taking all this into consideration. And we have always been bottom up, so stock specific, but this is the time where you need to be more stock specific, because the sectoral trends are not there across most of the sectors. It is not as if you can generate alpha through sector selection. So you need to focus more and more on getting the right stocks. And that's what our focus are in terms of market caps we highlighted. So in our diversified strategies, whether it is focus fund or flexi cap fund, we are having larger weightage towards the large cap. So that is one construct of the portfolio we are having. And then, of course, we are looking at stocks where the balance sheets have been strong, where there is still some semblance of growth. And at the same time, they are available at some reasonable valuations, because some of the stocks which we have seen in the last couple of years, when they were doing or growing very fast, they were kind of trading at much higher valuations. But now that valuations are being questioned very rigorously, if at all there is some disappointment on growth. So more focus on the growth versus valuation combination.
All right. Hi, Ajay. Good afternoon and good to see you, Ben. Nigel on this side. Ajay, it's sounding like it's going to be a difficult year. What would it mean, though? A time-wise correction? Or should we brace ourselves for a larger negative year in terms of returns? Because for the last 6-7 months, actually, the Nifty has gone nowhere. In fact, we're a little bit lower. So if you could define difficult here.
Yeah. Good afternoon, Nigel. And you're right. We believe that there is a bit of overvaluation with respect to the growth which we are witnessing. And if you look at the Nifty itself, the overvaluation might be 10 to 15%. But if you look at the mid cap, especially, the overvaluation might be much more. So the overvaluation obviously can get corrected in two ways. It could be actual price correction, or it could be a time correction. Now you are asking a very billion-dollar question whether it would, which one of these would be the case. I don't think anyone can predict with any certainty whether it will be actual time correction or actual correction, or whether there will be a time correction. But we feel that there has to be a correction. So if you just go in the recent past itself, October 21 to March 23, 18 months of period, there was no returns. So it is quite possible that we have that kind of time frame, or maybe even a bit 1 or 2 quarters more than that, where you don't have too much of returns. But one thing is clear to our mind, that the returns which we have witnessed in the recent past is not likely to happen. So the investors need to tone down their expectations. But at the same time, and this is going back to the initial question, that how do the domestic investors react? The options for the domestic investors, equity remains the best option from the long-term perspective. If you have a 3-year plus view, then the kind of returns which you get, and especially on a post-tax basis, is going to remain the best in equities. Even with a slowdown, we are seeing a 5-6% growth, or that is about 10-11% nominal growth. And typically, over long periods of time, you get returns which are in line with the growth if the valuations are reasonable. And if the valuations are not reasonable, which is the case at the moment,
Yes.
we might have some bit of longer time frames to get the same kind of returns. So what we might be expecting a return in, let's say, 5 years, you might get it in 6 years. So that kind of situation may happen.
Yes.
But equity markets still remain the best opportunity for returns. Yeah.
Got it. Near-term pain, but longer-term gain. Tell us, Ajay, then, if you're in for the longer haul, then what could be that pocket where you could get reasonable valuations, good theme to play as well, and earnings will ultimately look up. What is that top theme that you all will look to play in this period of uncertainty?
Right. So the top theme we are playing, and we are kind of reasonably overweight, is the banking sector. And we have seen the updates from the banking, a few banks. And we have seen that they have kind of shown, or kind of indicated, between 7 to 10% kind of growth from the credit system perspective. And of course, we need to see how the margins would be. But the good part about the sector is that the growth is reasonable. There is a bit of a slowdown like other sectors as well, but it is still close to the double digits. There is a bit of hit which will happen on the asset quality fund, but again, it will not be too much, because just few pockets like microfinance and a bit on personal loans, which anyway the regulator has kind of put some curves, and therefore the growth has anyway slowed down, and they're all short cycle. And what we are expecting is that the interest rate cut cycle will be at a slower speed, and it will be shallow. And in that scenario, the margin hit will not be much. So basically, the growth and the business performance will be very stable. And importantly, this is the only sector where the valuations are lower than the last 5-year averages. So this combination is very good. And we feel very confident that it will be one of the sectors which will do well in relative terms. Another sector where we are a bit positive is the healthcare sector, and where admittedly the stocks have already done well. So the starting point in terms of valuation is not as good as the banking sector, but it's still, we have a few opportunities, and this is more stock specific opportunities rather than across the sector, where some companies, either they're in the specialist pharma space or complex generics, they have some good growth opportunities. The third sector is the real estate sector. In the real estate, we have seen that the cycle has turned, and the inventory levels are down to maybe 14-15 months across the top 7 cities or so. And that is down from 40 months of inventory. So there is a substantial um, correction in the inventory levels. And as and when the launches come, which we are expecting starting from this quarter, that the launches will increase, the sales and the collections would increase, and that will further take up the growth prospects of the sector. So we are a bit overweight on this sector as well.
Okay, all right. We will leave it on that note. Thank you very much for joining in, Ajay, and we look forward to more conversations during the course of 2025. Thanks for being with us today.